More than half of global GDP, roughly $58 trillion, is moderately or highly dependent on natural systems, from stable water tables to functioning pollinator networks. Despite this reliance, the existing financial architecture ignores ecological reality. By treating natural systems as free externalities, traditional accounting systematically misprices risk. This imbalance is captured in the UNEP's 2026 data, which shows a 30-to-1 ratio between nature-destructive and nature-protective capital flows. While $220 billion goes toward nature-based solutions, an estimated $7.3 trillion is directed annually toward nature-negative activities. Private finance accounts for $4.9 trillion of those nature-depleting flows, showing how deeply these risks are embedded in utilities, industrial materials, and energy sectors. Directing trillions into the degradation of the foundational infrastructure of the economy creates a systemic misalignment. This misallocation generates profound risks for global financial stability and corporate valuations. In April 2026, the International Sustainability Standards Board moved to codify nature-related disclosures, signaling a broad institutional move toward a nature-positive financial model. This move stems from the macroeconomic evidence that climate change and biodiversity loss are not separate issues, but interconnected phenomena that directly impact a company's ability to generate cash flow. Financial institutions are now transitioning nature into a quantified, auditable asset and liability, using standardized metrics to bridge the gap between ecological health and the corporate ledger. This structural change is being executed through two primary levers: the mandatory requirements of IFRS S2 and the operationalization of natural capital accounting. By treating nature as the keystone infrastructure of the global economy, the market is beginning to price ecosystem degradation directly into the cost of capital. This comparison matrix shows the migration from the historical TCFD recommendations to the audit-grade requirements of the IFRS S2 standard. This shift involves 9 specific tightening mechanisms designed to increase quantitative precision. Under the financial effects and Scope 3 rows, the mandate is clear. Companies must now disclose quantified anticipated financial impacts over multiple horizons, requiring visibility into the furthest reaches of the supply chain. The physical risk data row shows the most significant change. Regional or national averages are no longer sufficient. IFRS S2 requires property-by-property, asset-level physical exposure data for every node in the value chain. To survive these audits, corporations are deploying geospatial analytics, climate modeling, and digital twins to prove their resilience to specific, localized hazards. These models must quantify both direct and indirect impacts, such as how localized water stress or acute weather events interrupt logistics and shift energy costs. Furthermore, the ISSB has clarified that these nature-related disclosures are inherently required under the existing IFRS S1 general requirements. IFRS S2 effectively ends the era of narrative-based sustainability reporting. A corporation's physical resilience is now a matter of documented asset-level evidence. Because these disclosures are mandatory, physical risk data has moved from the sustainability department into the daily operations of procurement teams and credit committees. Procurement teams are implementing site-level triage, embedding climate exposure data into every supplier selection and contract renewal. Suppliers in high-risk zones without adequate adaptive capacity are being replaced or subjected to mandatory contingency planning to protect the buyer's own IFRS S2 compliance. Capital allocators have adopted the hazard-adjusted EBITDA model to reflect these risks. Standard cash flow projections are discounted to account for escalating insurance deductibles and the expected downtime caused by extreme weather events. This allows real asset investors to classify portfolios into specific action categories: hold and adapt, or exit now. Triage is being accelerated by the retreat of traditional insurers from high-risk zones, forcing companies to rely on more expensive parametric insurance for liquidity. Lenders and equity markets now treat physical resilience as a mandatory baseline for favorable financing. Historically, corporate accounting failed to recognize natural assets. A living forest holds an asset value of 0 until it is felled and sold as timber. Natural capital accounting, or NCA, corrects this by translating biophysical data, such as tons of sequestered carbon, into auditable monetary values. Under International Accounting Standard 38, investments in ecosystem services can be recognized as intangible assets, integrating ecological health directly into the core financial statements. Foreco, Tasmania's largest private forestry manager, utilized this approach to publish the first independently assured natural capital reports structured like traditional financial statements. The audit revealed that Foreco's natural capital balance sheet was valued at 3 times the size of their traditional financial sheet. By recognizing the financial value of standing forests for water regulation and carbon storage, the firm's operational incentives changed. They transitioned from short rotation harvesting to long-term stewardship. This shift unlocked hundreds of millions in sustainable finance and secured premium pricing in environmental markets by rewarding biodiversity alongside carbon. Natural capital accounting aligns fiduciary duty with ecological preservation by proving that standing ecosystems can carry more balance sheet weight than commodified timber. Major data providers are now embedding ecological telemetry directly into portfolio construction, mapping exact asset locations against water stress and biodiversity indices. These tools are fueling the adoption of the TNFD framework, which provides the standardization necessary to price nature risk into the global market. Frameworks like the GS Sustain Nature tool allow institutional investors to adjust cash flow models based on a firm's impact on the drivers of nature change. As investors gain access to this telemetry, corporate managers are being forced to manage ecological footprints to maintain investor interest. Consequently, the cost of capital is beginning to diverge. Nature-positive entities are securing access to cheaper, highly structured capital, while nature-negative firms face escalating risk premiums and exclusion. This pricing shift extends to sovereign debt. The IMF and World Bank are beginning to integrate nature-based metrics into debt sustainability analyses to address the double vulnerability of emerging economies. For the CFO, the playbook for 2026 is clear: audit supply chain dependencies, implement NCA to redefine enterprise value, and apply hazard-adjusted EBITDA projections. By embedding the quantified value of natural capital into the balance sheet, organizations can navigate this transition toward a resilient economy. Those who delay risk rapid capital destruction as these physical and regulatory